Hey traders, this is Blake Morrow with Traders Summit, and I have two distinguished gentlemen with me today. I have Mr. Dick Matthews of Pardus FX, and I have Mr. Michael Brown from TraderX. Good to see you, gentlemen. How are you today?
Good.
I'm very well, thank you, Blake. It's a fresh day here in London, but Arsenal are top of the league at the time of recording, so both Dick and I are very happy chaps at the moment.
Well, I'm glad to have you both here. You know, we're heading into I don't want to say historic. Historic is like a really lazy way to describe the events of next week. But we do have the Fed, ECB, and the Bank of England. Other central banks are meeting next week. It's going to be an exciting week. But how are you guys preparing, and what are your thoughts really going into this next week? And let's start with you, Michael. Like, how are you feeling with equities as bullish as they are? Financial conditions continue to loosen. What are your thoughts here as we head into this next historic week?
Yeah, every week seems to be a historic week at the moment, doesn't it? But you rightly say, next week is a really big one. It's the first Fed meeting of the year. We're going to see that downshift to a 25 bips hike, and we'll probably see the conversation start to get rolling about how the tightening cycle is going to come to an end. The ECB are going to deliver another 50, and the Bank of England will probably go 50 as well, despite the rather poor retail sales figures that we got out of the UK towards the tail end of last week. I think my view on risk assets really and equities, we've had an incredibly strong start to the year. The S&P is up 5%. The stock 600 in Europe is up 7-8%. I think when I looked earlier on, it's been a remarkably strong start. And I think this comes back to a point that Dick and I made when we were last on before the previous round of central bank decisions, in that the market just still is not really taking notice of this message that rates are going high. And they are going to stay high for a pretty long time. And the bulls buying into risk assets at this point in time with earnings starting to soften and activity data on the wane, I just don't think the rally that we've seen is justified by the fundamentals of the economy.
Yeah, and what do you think about that, Dick? I mean, we've got this significant rally in equities. I mean, we're near the highs of the year in the S&P, and it just seems like the market is completely playing chicken. I know that's been thrown around a lot, that terminology, but the market's playing chicken with the Fed and other central banks. What are you thinking here?
I just think it's absolutely unbelievable. And as Michael was saying, the Fed has tightened and tightened and tightened, and we have now got looser conditions than we had previously. I just wonder whether the Fed might come in and do 50 basis points next week.
Whoa, that's a bold call.
That would be a very bold call, and I think that would. I mean, we haven't had a central banker, Dick, that has been that has done anything like that since the Greenspan days, I would say.
But they must be getting so frustrated with the way conditions are easing. Crypto's back up strong, equities are strong, the dollar's softer. I just find it really, really difficult. I think the easiest one next week actually is probably ECB, because they pretty much said what they're going to do. They're going to do 50 basis points. Christine Lagarde's going to come on, give a fantastic press conference as she always does, which we'll all look forward to. An afternoon kip. And I think that's the easy one. The Bank of England, I actually think, will wimp it and do 25.
So, well, that brings me to another question. I'd love to get your opinions here. And Dick, we can start with you on this. How much influence do you think that the Federal Reserve, since they're going to be first up to bat, using the baseball analogy, but they're going to be the first ones up, how much influence is the Fed going to have on the ECB and the Bank of England following?
I don't think they will, actually. I think certainly the Bank of England has ignored what the Fed's done to its detriment. Hence, you've seen a softer sterling, consistently softer sterling. The ECB's already telegraphed very, very well what it's going to do. So I'm not sure that it will, unless the Fed does come in with a surprise, a bigger than expected move up to 50 by 50.
Yeah. How about you, Michael? What are your thoughts there?
No, I would completely agree with that. I mean, I don't think that the Fed are going to go 50. I think 25 is pretty much nailed on. I don't think the ECB or the Bank of England are going to be particularly bothered by what the Fed are doing. All three seem relatively well set on their kind of predetermined courses at the moment, and I don't think what one does is going to influence the other two too much. One thing I would just point out, you mentioned financial conditions, rightly so. It is remarkable what we're seeing in the States in terms of, the Fed have hiked and hiked and hiked. Last year was the biggest amount of cumulative tightening in terms of rate hikes since the very early 80s. We've had 125 bips of hikes since early November. But financial conditions have loosened to where they were before the Fed even hiked for the first time back in March of last year, or almost 9 or 10 months ago. And I think what's remarkable is the fact that Fed officials have shown really no desire to push back on that. Actually, Fed speak has been becoming more and more dovish. Even some of the hawks on the Fed board, Chris Waller, for instance, indicating he's in favor of a 25 basis point move now. Whereas when you compare that to what's happening in Europe, the ECB have been remarkably quick to quash any sort of speculation that they may make a more dovish move. There was a report out, I think it was early last week from Bloomberg, that the ECB may be considering scrapping the guidance Lagarde gave in December that we're going to see 3 50 basis point increases in a row. Within about 45 minutes to an hour, there were sources out completely rubbishing those remarks. We had speakers pretty much every day after that. And I think it's just remarkable how resolute the ECB are being in terms of trying to stick to that message and trying to tighten financial conditions in the Eurozone. And as a result, and when you've got the data coming out as it is, it's no surprise why we're seeing not only the Euro rally, but also this kind of broader rotation out of the States and into European assets.
Yeah, I mean, the DAX has been just charging higher this year. It was the first, one of the first major indexes to hit all-time highs of the year, and it continues to show like it's breaking out to the upside. Well, so let me ask you this. I mean, with all of this question marks that you both of you gentlemen have, where, as a trader, where is the place to be following these three central banks on Friday? Am I supposed to be, just a dollar buyer and think that this is it for the Fed? The Fed has, reached close to a terminal rate, and they're going to keep rates, maybe unchanged for a while, and I need to be buying dollars? Or do you have other ideas out there? Let's start with you, Michael. What are your thoughts here?
Yeah, so I don't particularly want to take a view on the dollar at the moment. I think with the market not really listening to what the Fed are saying, it's very, very tough to trade the greenback as a result. My gut feeling says medium-term view is dollar weaker. The data is consistently surprising to the downside in the States. It's consistently surprising to the upside in Europe. I think that's probably going to continue for the time being, at least. Kind of recession worries in Europe are fading pretty rapidly, and recession worries are mounting in the States. So given that the US has kind of lost its place as the best of a bad bunch, if you like, in terms of global economies, and the dollar as a result in terms of G10 currencies, I'm not looking particularly favorably, I should say, upon the greenback at the moment. But if you want my sort of one trade for after these three central bank decisions, the position I'd actually want to be in at the moment, and it pains me to say it, and I think Dick knows what's coming here, but it's long euro sterling. You've got the ECB, and he's laughing away there, and I'm flinching in pain by even having suggested it. But you've got the ECB, who are resolutely hawkish and really sticking to the course in terms of the rate hikes that they're going to deliver. And then on the other side, you've got the Bank of England, the old lady of Threadneedle Street, literally 2 minutes down the road, who are almost looking for any excuse they can to ease off in terms of the tightening cycle, bring that rate hiking cycle to an end, and potentially even look at loosening policy towards the tail end of this year. I think their inflation forecasts are going to be very, very interesting. They already see, I think, CPI at 1.4, 1.5% in 2024. That's probably going to come down even more, and that's a clear signal that the bank are looking to move to an easing bias. So in the longer term, of course. So you've got a resolute hiker in the ECB. You've got a reluctant hiker in the Bank of England. It goes against every single bias within my macroeconomic and trading mind. But long euro sterling is how I'd want to position myself at the minute.
Well, and now, Dick, I'm going to get your opinion here in just in a second, but I guess I have to ask you this, because the rate is trading around, 88 pence, just a little bit above that. Can we surpass 90 once again?
I think we could. If we get, I think the BOE will go 50 in Feb, but I think we'll probably get 25 at best after that from the Bank of England. Whereas from the ECB, you're looking at perhaps even another 100 basis points of hikes after the February meeting, and I think that is enough probably to push us north of that 90 mark, and then it becomes a momentum trade. If we can get north of that psychologically important 90 handle, Euro bulls are just going to come flooding into the equation. So I think although the pound has had a decent start to 2023. I was going to say 2022. The pound's had a decent start to 2023, particularly cable. I think sterling is the best performing G10 against the dollar thus far, or at least it was until it fell off a cliff earlier this morning. I'm not particularly bullish on the pound's fortunes over the short and medium term.
Well, Dick, to your credit, you have been more of a sterling bear in our conversations. And we do have the euro sterling, as Michael pointed out, is making a move higher. But is that the place that you'd want to be following these three central bank meetings? I mean, should I be, reallocating myself back into stocks right now? I mean, what are your thoughts here?
I fundamentally agree with Michael. It does pain me to say that I like the euro. I favour the euro at the moment.
I thought you were going to say it pains you to say you agree with me for a minute.
No. Two great maxims that I've always been taught to me: don't fight the market and don't fight the Fed. Right. So I'm just staying out of, not getting involved in trading dollars, because I think the market's wrong, but I don't want to fight the market, and I don't want to fight the Fed by going with the market. So I agree with Michael. I just don't want to get involved in that. But I do agree with Mike as well that the euro looks the most set currency at the moment. That's one I would favour. I'd be buying euros over sterling. I still think there's a little bit of political risk in sterling, which hasn't become apparent yet, and this will grow. We've got local elections over here in May, I think it is.
Oh, good.
Which should all be great fun for the Conservative Party. Who've got another scandal going on at the moment, a taxation scandal, and every scandal that they can get. So I think there should be some tail risk on sterling. So my trade would be, unfortunately, I'm loath to say it, to buy euros and sell sterling.
All right. Well, I got you both to agree on that, but let's circle back to. Oh, actually, I forget circling back. I want to ask you just one last question before I let you go. You look at yields, and you got bonds under pressure. Yields are starting to creep back higher here in the U.S. Do you guys have any thoughts on the bond market right now? Michael, we can start with you.
Yeah, it's an interesting one. I mean, I think it's clear that Treasuries. Sorry, I'm just looking at a chart over to my left rather than looking at your lovely face, Blake. It's quite clear, I think, that Treasuries are pricing rate cuts. You look at the 2-year at 4.2, 4.25. It's quite clear that the market doesn't anticipate the Fed staying at its terminal level of about 5% for particularly long, which over a 2-year tenor makes sense. Over shorter than that, in my view, the market's got that wrong. I think when I'm looking at the bond market, the 10-year is obviously the benchmark everyone looks at. It just doesn't want to spend much time below 3.4% at the minute. And I'm just wondering what is going to be the catalyst to really force us below that level. And the two that I can think of, given that activity data doesn't really seem to be doing it at the minute and forcing us to stay below that handle, is a negative payrolls print. If the labour market really starts to soften rapidly, then that is going to be a trigger for the Fed to not necessarily halt the tightening cycle, but give it serious consideration. And obviously, you've seen a lot of news about layoffs in the tech sector and in the banking sector in particular. So that negative payrolls print might not be too far away. And I think really that is the catalyst that we may see, other than if we start to see a really rapid rolling over of core inflation, not headline inflation, core inflation. That could be the other thing. But for now, I think Treasuries are are relatively steady above that 3.4% mark. And we don't want to get into it in this video, of course, because it's a whole different subject, but that's probably one of the reasons for the relatively stable yen that we've seen over the last couple of days as well.
Yeah. Okay. Well, thank you. And I'm going to come back to you. Just one last thing, but what are your thoughts on? Do you have any thoughts on the bond market, Dick, yourself?
I pretty much agree with Michael again. It's a pretty boring conversation. The two of us agree with each other. The only thing I will say, I think that the market is ignoring this tight higher for longer. I think the Fed's going to move rates up, and the terminal rate is going to stay around about 5% for a lot longer than people think. And I think we've moved back into an era. We've moved away from the 0 interest rate era and the 1% interest rate era to a new era of interest rates sticking around about 4 or 5%. So I think they're absolutely petrified of inflation coming back.
So okay, then I'm gonna start with you, so this way you don't have to agree with Michael on this last point. Where are you at as far as what are you listening from the Fed this next week that could really let the market know that they mean business and they're going to keep rates at these levels? Is there anything that you're on the lookout for? Any verbiage that you're looking to hear?
I can't imagine how they can say it more clearly than they have been saying it time and time again. Watch our mouths. Rates are going higher. They're going to stay higher for longer. And I don't know what they can do unless they do come in and surprise the markets with a 50 basis point move. I just don't know what more they can say.
So how about you, Michael? Is there anything that specifically you're listening in for next week?
Well, besides the obvious, which we've already heard, which is a very, very explicit Chair Powell saying higher for longer almost as many times as he can in a press conference. There's not a lot else they can say. I mean, I think actually one thing I would watch, and I haven't done this analysis myself, which is perhaps slightly remiss of me, but actually just keep a tally of the number of times Powell says that during his press conference, because I think that will be really the tell for markets. And you can even do that anecdotally, just keep a sort of mental note of all the questions he's asked. He gets 12 questions, how many of those questions included a reference to rates staying high for a prolonged period of time. And I'm pretty sure if it's not 12 out of 12, it's going to be damn close to being 12 out of 12.
Well, I'm sorry. Go ahead,
Seven
Dick.
times, because 7 times is the number of times you have to repeat something to get your point over.
And the market still won't listen.
Well, then I'm going to look to confirm those 7 times or maybe 12 times with maybe some dots to go with it on the dot plot. How about that? Well, gentlemen, I want to say thank you so much for joining us here at the Trader Summit community, and I just want to say thank you for giving your thoughts ahead of this historic week that we have coming up this next week with the Fed, the ECB, and also the Bank of England. I think we're going to be working overtime between the three of us. And if you like this content, this exclusive content that we got from Mr. Michael Brown and Mr. Richard Matthews, make sure you give them a thumbs up, smash that like button, help the YouTube algorithms, and thank you for spending your quality time with us. And thank you, gentlemen, and have a great day.
Thanks again, Blake.
Cheers, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.